The most profitable day. The day no trade was made. It sounds paradoxical. How can the most profitable day be the day you did nothing? Yet decades of behavioral finance and performance data suggest that for many investors, the highest return days are often the ones when they did not trade at all. 1. The evidence on trading frequency. Large-scale brokerage studies by Brad Barber and Terence O'Dean show a consistent pattern. Higher trading frequency, lower net returns. Overconfidence, more trading. More trading, higher costs, and worse performance. Investors who traded the most often earn the least after costs. In other words, the more active days you have, the lower your long-term return tends to be. 2. Missing the best days problem. Market returns are highly concentrated. A small number of trading days often account for a large portion of long-term gains. If you exit and re-enter frequently, you increase the probability of missing strong rebound days, being out during sudden rallies, re-entering at higher prices. The investor who stays invested and does nothing is present for those outlier days. And outlier days drive compounding. 3. Compounding rewards inactivity. Compounding requires time, continuity, stability. Frequent trading interrupts dividend reinvestment, earnings growth capture, tax efficiency. Investors influenced by Warren Buffett often emphasize that long holding periods amplify returns. The most profitable day is often not a day of action. It is a day of uninterrupted compounding. 4. Behavioral friction, the hidden cost of action. Psychologist Daniel Kahneman demonstrated that frequent evaluation increases perceived losses, myopic loss aversion. More checking, more emotional discomfort, more reactive decisions. Each trade may feel like control, but often it is just emotional relief. The day you resisted trading may have saved transaction costs, tax liabilities, mistimed exits, emotional mistakes. Those invisible savings compound. 5. The psychological illusion. Action feels productive. Inaction feels passive. But markets do not reward motion. They reward positioning. The investor who sold during volatility might have avoided short-term discomfort, missed long-term recovery. The investor who did nothing endured discomfort, captured recovery. Endurance often outperforms reaction. 6. The true, most profitable day. The most profitable day is often the day you didn't panic sell, the day you didn't chase momentum, the day you ignored short-term noise, the day you stayed aligned with your plan. Profit does not always come from action. Sometimes it comes from restraint. 7. When doing nothing is not profitable. Inaction is not universally optimal. It becomes harmful if fundamentals permanently deteriorate. Allocation becomes misaligned. Risk tolerance changes. Strategic inaction works only when supported by structure. But unnecessary action is often more damaging than patient consistency. The core insight. The market's biggest gains are often sudden, concentrated, emotionally uncomfortable. The investor who trades frequently risks missing them. For many long-term investors, the most profitable day was the day they chose not to trade. Because in investing, activity feels rewarding, patience is rewarding, and the compounding engine runs best when left undisturbed.